Financial advisors have been using the 60/40 stock bond portfolio recommendation for decades. And that is no longer a proper allocation for people if they truly want to optimize for their retirement income and their retirement outcomes. So in this video, we're going to break down what another potential solution will be. And as always, remember that this video is not intended to be financial advice. This is simply just education and not any recommendations to buy, sell, or trade any securities. Now, with that being said, we're going to dive in and let me share my screen. And let's look at, here we go, the 60/40 stock bond portfolio and rethinking it. And now here's the key thing. We want to think about just simply repositioning our safe money portion because there's a smarter approach to do so. So we're not going to touch anything with the stocks, but more so, there's a couple of solutions that could make more sense than the money that you have in bonds. And here's what I mean. Some of the limitations that exist around bonds are falling bond prices. Rising interest rates have created a challenging environment for bonds when their prices bond prices actually drop when rates climb. Limited upside. Bonds offer minimal growth potential. Their returns are capped by their yield to maturity. And lastly, portfolio drag. Recent years have shown that bonds have underperformed, and they're creating a drag on overall portfolio performance. Now, bonds have always been the safe solution and the safe money. Technically, you still can lose some in bonds, but you're not going to have as large as losses as you could have with stocks. And that's why they've been almost inputted into, the modern portfolios to make sure that you do have some downside market protection. But this is where we can enter fixed index annuities for a better bond alternative. Why? Because of principal protection. Your money is completely protected against market losses, and your balance never decreases due to market performance. You have growth potential. The returns are linked to equity index performance. You participate in market upside without the downside risk. And then lastly, long-term security. These are designed for retirement savings, and many fixed index annuities allow up to 10% annual withdrawals for flexibility, whether that's for income or for emergencies or whatever. You can access your money inside of these annuities, which most people think that you can access your money for some reason and that it's completely tied up, and that's just not the case. Now, how can fixed index annuities improve your diversification in your portfolio? They give you multi-index exposure. You get to diversify across various market indices within a single product. You get reduced correlation. They do have less correlation with stocks than bonds have. You get the volatility reduction. It smooths out your overall portfolio performance, can help you pick up market gains when the market does rebound. And then also retirement protection. It minimizes major losses during your withdrawal years. Now, just as an overview here, this chart came in slightly too big. Let me see if I can make it a little larger. But this just simply shows you the average rate of return for bonds versus fixed index annuities. Treasury bonds will average maybe about 2.5% returns. Corporate bonds, maybe about 4% average returns, while fixed index annuities conservatively will do about 5.5%. More moderately performing fixed index annuities, anywhere from about 6.5% all the way up to potentially 7% returns. And so if we look at, the different benefits of fixed index annuities compared to, where the market has its drawdowns, this is how it gives you, the real world protection, like it says. You get principal protection because your initial investment is guaranteed. You get locked in gains. Any previous growth is secured during market drops because every year you actually get to lock in your gains. You have risk control mechanisms. There's automatic rebalancing inside of the accounts, and then also sequence risk mitigation, which gives you crucial protection for retirees that are taking withdrawals. I'll have another video on the sequence of returns risk. That is a real risk for a lot of retirees to make sure that they don't run out of money in retirement. And now, simply enough, if we just we took a sample case study of the portfolio impact of just reallocating the safe money that you have in bonds, or maybe it's even in cash or CDs, all these other safe options, but they only, kind of get capped at maybe 3% returns or 4% returns. There's some CDs now are offering maybe a 4% growth, but fixed index annuities can do better than that. And so if you did have a traditional 60-40 portfolio and 60% of your money is in stocks, the average stock market return is about 7.5% per year on average. Some years will be higher, some years will be lower. Bonds, based on the US aggregate bond index and the historical data, they only average about 3.2%. So overall, your total portfolio is only expected to grow at about 5.78% average returns per year. And the risk is that both assets actually can lose value simultaneously. It's not very rare that bonds are negative, but they can be. They can have negative returns. With an optimized 60-40 portfolio using stocks and fixed index annuities, you can see how stocks, if they average 7.5% growth, and if you have a fixed index annuity that averages 6.5% growth per year, your total portfolio now can grow at 7.1% average return. And now only 60% of your money is at risk of the market, because 40% of your portfolio would be protected from losses that you don't ever have to worry about again. So one other question I commonly get is, why hasn't my financial advisor recommended a fixed index annuity? And it comes down to, 3 or 4 main points. Licensing limitations. Fixed index annuities do require a life insurance license to sell, actually. And many advisors lack this credential and can't offer these products. Many financial advisors are really great with growing your money in the stock market, but they kind of stop there. They also have outdated perceptions. Many advisors base their opinions on older, less flexible annuities from decades ago, when they used to have really high fees and they used to not get good growth. Trust me, from 20 years ago, I wouldn't have recommended those annuities either. Now it's become a staple that a lot of my clients are going to for their safe money that they want protected from the market. Company directives. Some advisors only recommend products that their firms promote, which limits their available solutions. And they get paid a management fee on money that you have with them in the market that they're managing. FIAs, fixed index annuities, since they're not in the market, they sometimes therefore don't feel they're incentivized to share how they work and how they could be, a benefit to individuals. And then lastly, just a modern evolution. Once again, advisors base their opinions on less flexible annuities from, maybe 20 years ago, while today's fixed index annuities offer many improved features and flexibility that many advisors simply just haven't researched. On top of that, one last thing that I'll add is that if we just go to CNBC here and pull up and we look at the S&P 500, this is the S&P 500 as of today, which is currently Tuesday, April 22nd. You can see if we look at the market over the last year, we are down, right? And the unique thing about fixed index annuities is that you get to participate in certain indexes just like the S&P 500. And so right now, if the S&P 500 is down 12% from 1 year ago, 12% from 1 year ago, you put yourself in a position where you can get into, the S&P 500 at 5,200 at a price of 5,200, right? And if the index goes down inside of your fixed index annuity, remember, you're not going to lose any money. But if the index goes up, you're going to be able to participate in these gains. And it could take about a 15% return just to get back to, the 6,000 level that the S&P 500 was at just a few short months ago. And so by putting your money into a fixed index annuity, you position yourself well for when the market does rebound. And we don't know if that's going to be 12 months from now, 24 months from now, or longer. But when the market does come back, the fixed index annuity allows you to participate in those growth and those gains, where bonds just simply don't do that. So for an overall conclusion, evaluate your current allocation, review your portfolio's bond performance, see how it's doing for yourself, and explore fixed index annuity options. Research different fixed index annuity products and look for those with strong index options, good ratings from the different financial companies that will rate companies, and any reasonable caps or participation rates. And lastly, consult with a professional. Work with somebody that actually knows and understands how annuities work and what they are. If you guys don't know who to turn to, that is one area that I do specialize in, is helping people with their safe money in retirement that they don't want to lose in the market. So if you guys have any questions, I'll include a link below this to my website, thewealthacademy.com. Academy is spelled with a K. If you guys want, though, just click the link. That'll take you directly to our website where you can schedule a call with myself and we can chat about if a fixed index annuity would be right for you. If you guys made it to the end of this video, thank you so much for watching and for hanging out with me. And as always, if you guys have any questions on retirement, feel free to drop it below in the comments. Maybe I'll create a video on it and answer it, or once again, schedule a call. Take care.